kind of get started here. Okay, so the solution that we're offering is really unique, and we're really just stretching our wings and in the way that we're offering it. And you know, I come from a marketing background, so we do a lot of marketing, and as you guys have probably saw on the ad and or the emails that I've been sending to you guys, that we're kind of operating retail. In other words, we're marketing on social media, and we bring in leads, and there's a couple of us that have different levels of that. So when you're getting started, we have some leads that you guys can purchase for $22 a piece, which give you a really good ROI because it gets your feet wet, gets you out there, get you some appointments in your calendar. And in fact, here I'm going to share my screen to show you guys my calendar, so you can see kind of how it gets filled here. So, and really, we're just beginning the year, and so it gets busier and busier as we go on. So this is my calendar for this week. As you can see, I'm booked solid for the rest of the day, and already next week is filling up. And I spent a lot of time working to bring people to this event today, and so it can get really fairly busy. You guys can have 3, 4, 5 appointments. There's times when I'm booked solid from 7 or 8 o'clock in the morning until 7 or 8 o'clock at night, and there is no shortage of people looking to pay off debt, right? United States, we're full of it. And this morning in a training meeting, because we have meetings every day, one of our top agents does a training every morning will be 6 o'clock my time. I'm on the West Coast, but it's 8 o'clock Central Time, and he really goes through the solution. In fact, he's one of the creators of the solution, of the entire solution. And so let me reshare now on the topic that we are going to be covering. All right, get it there. Tim, if some others come in, just let them in, please. Okay. Okay, what you see here, what I'm going to do is I'm going to show you the presentation that I actually do for the clients. And then I'm going to go into how it progresses into the full solution. So the name Hybrid Mortgage Arbitrage is a name that I created because the way the technology and the way it's all set up, we actually operate as our own businesses, and so that's the way I treat it. I treat it as if it's my own business, and which it is. And the contracts, however, for the insurance part of it, or actually all of it, is directly with the carriers. Okay, so yes, you'll be working with me. I'll be training you. I'll show you, the ropes and how it works. But you're vested on day one. So in other words, the life insurance company is paying you directly 90% and out of the target premium, which if you guys have been in insurance before, that's pretty high because we don't create the policies based on the way people normally get life insurance. Not saying, hey, I want a $500,000 policy, or I want $1 million policy, or I want to spend this much on premium. We create the policies based on what they need to do in paying off their debt and their mortgage. Okay, so Hybrid Mortgage Arbitrage is a name that I've coined, And it's because when we are demonstrating to the clients how they um, get income from paying off their debt, we use a spreadsheet called an arbitrage. And I don't know if you guys, most of you, I've sent the video out so you kind of understand somewhat what that is. But so when I am talking to a client and I originally get them on the phone, I and understand they come to the call because they want to pay off their mortgage. They want to pay off their debt. Um, and and many times they're looking to retire or save money or leverage the equity in their properties, invest, save money, and and there's some other things. So this morning, I am, and I've been doing marketing for a while, and I'm also creating sales funnels. So as agents, yes, you can get the leads, and the leads, like I said, start off at $22 a piece. They're really inexpensive, and you make money on the technology and you make money on the insurance products. But we also try to protect them with gap insurance because we don't want them, even though they can use the insurance policy with living benefits because it comes with living benefits. We don't want them to go into the policy because the goal with that is for it to yield returns for them for the rest of their life. So when they come into the call, I of course introduce myself to them. I warm up with them, and I ask them what are they trying to do? What caught their eye about the ad? Because they've come in from social media, TikTok, Facebook, Instagram, and on and on. And they responded to an ad telling them that they can pay off their mortgage early. Now, we all know, if you guys have been online, there's lots of companies out there saying that they can help them pay off mortgage. There's Dave Ramsey and Susie Orman and all the personal finance gurus. But what you're going to find that this is really unique compared to them. So again, I find out why. What are they trying to do? What are they trying to accomplish? And that gives me a good idea of how to proceed with my presentation. I also relax them. I let them know that I'm not going to try to do a big presentation and sell them something or get them to do something that they don't want to do. And so I relax them. I'm educating them, and that's the approach that I take. Okay, so since I am meeting with people from Facebook, I introduce myself and the company. And so again, Financial Literacy Group is the name of the company. I've been in business pretty much my entire adult life. Started the company in 2012. And what financial wellness is, if you guys don't know, because there's lots of implications with that, is helping our clients optimize their financial position. So they're ready for what's going on in their lives today, but they're also prepared for what's going to happen or what they need to do in the future. Okay. And I explain also that what financial wellness is, it is not just financial services, but we use a full set of tools. So technology, mathematical algorithms, software, yes, financial services, life insurance, education, because we have online courses that that the clients can take at their leisure. So what we're doing is we are making them smarter about their money and putting them in an optimal financial position. Okay. So Financial Literacy Group works with individuals and families. However, we do the same thing for business owners. Now, if you guys aren't familiar with this part of it, this can be offered through business or benefit brokers. This is an employee benefit. Okay. And it is the same thing as financial wellness. So Betterment Inc. is our business to business division. So employers contract us to help their employees get in a better financial position. So again, individuals and families, financial wellness, a financial literacy group, but business owners, right? This helps them in a lot of ways. It helps them relieve the stress with their employees who are having financial situations, credit or whatever. But again, the goal is to make them smarter about their money, spend their money better. So for an employer, this helps them, especially now. In fact, there's some documents that are some reports that have come out lately that financial wellness is going to explode between now and 2028. Okay, so these tools are crucial for people. The employer, he has now a better workplace culture. He has safer employees. They're not missing work because they're dealing with financial problems. So it reduces absenteeism. It reduces health problems because people have health problems for their with their finances. And again, wellness itself is very big. And so financial wellness is really in time for right now. Okay. I also explained to them that I am an authority on this. And I've written 4 books. Actually, I've written more than this in the last couple of years because I'm not showing the books that are regarding recruiting insurance agents, because I've created funnels and books for that. Recruiting insurance agents, recruiting mortgage brokers and real estate agents as well. And that's going to be another big way that we're going to grow this really large. This morning, on the morning meeting, when I was mentioning it, and one of the promotions that we are going to be launching is, and you'll see why it works and why I am talking about this, but we all know that, people who graduate from university have debt. They have, had to get student loans, and now they're in debt after they graduated, and it could take them, years to pay that off, 20 years for, in some cases, 30 years. Some of them never get to pay it off. Okay. So this solution that I'm going to be showing you guys is a great way to help parents prepare to send their kids to college and get their finances together to help their kids, and so the kids aren't burdened after they finish school. So you'll see how it works for that. Okay, so again, we've become certified as a minority company, and we are looking for agents to help us in that endeavor. We work here in Southern California. That's where our association, or our office is. And there are 23 regions total across the United States. Some of them are multi-state, and California happens to have 2 offices, the Northern California office and the Southern California office. But as minority companies, we get access to all the minority companies in the association. And I think across the country, there's 12 to 14 minority companies. But another thing that it brings us is we also get access, because that's what the actual association is all about, helping us get access to corporations. So not only are we able to, help small companies, but we're also able to offer solutions to large corporations. So you're going to be seeing those. I'm not going to show too much of that today. It is in the books. So the economic community empowerment, yes, it's kind of political, but understand, guys, I'm looking to pull out all stops to offer this to everyone and anyone that we can. So the economic community empowerment is created to help businesses in underserved urban areas, people in underserved areas, and understand, yes, I'm an African-American guy, but you do not have to be an African-American guy to participate. in this. You don't have to be a minority. If you're representing financial literacy group, all we have to do is pay, I think, a couple $100 to join the other 23 regions. So each one would be $2,200, and now you have access to the corporations and the minority businesses in those regions. And it's big because, in fact, I owned a marketing company during the 90s. I joined and I built my company to millions of dollars a year. And I had contracts with Union Bank of California, Sunkiss, Quest Communications, Sanwa Bank, and on and on, Prudential. So there's a huge opportunity for you guys. Now, I don't want you to spread too thin. So if you are running in each and a region, then you would be able to bring in agents under yourself to take part of that on. Being an insurance agent, and if you're working and you're trying to go B2B, then you should really concentrate on that. If you are, working with individuals and families, that's where you should concentrate. However, we can bring in people either under you or aside, with you, and also have them attack or work with those other corporations. So the way it works with the corporations is all we have to do, first of all, is we register as a vendor for the corporation. But when we call in to their diversity supplier department, because that's what they're trying to do, is help minority companies get business with the corporations. We call in, we ask who handles the health insurance or who handles a certain division. And we don't have to make 1,000 calls to get to that person, right? We get their name, we call them. If they're not available, we leave a message. They will call us back. And depending on what we're offering them, the way it works with the corporations is they are contracting out specific, if they're doing healthcare, they're contracting it out, and they may have a contract with a insurance company for 3 or 4 years or whatever the case is. We find out where they're at in their contracting. If it's coming up, we get on their short list. If it's going to be, if they just signed a contract, we just put it in our calendar and we approach them, 8 months, 10 months before they go to contract again. Okay. So there are lots of opportunities here. So the book up here on the right top is a book that we use for what we're doing and helping people pay off their debt. The pros and cons of paying off your mortgage early is a way that you can, so they get to download the book free. We send them a funnel, send them an email, they download the book, and now they're in our funnel, and the funnel will pursue them to create an appointment. So in other words, it's doing the follow-up for you. Okay. So we're going to continue to create funnels. So I'm going to create a funnel for targeting parents who want to send their kids to college. So I've already written part of the book, and I'm going to be finishing it fairly shortly. Financial wellness, again, is for small businesses. And again, you guys will have access. If you haven't seen them already, you can have access to the books, right? ERTC. So we are, again, not only with the small businesses are we helping them with their employees, but we're helping the small businesses themselves, either raise funds, recuperate funds. And so the ERTC has been very big over the last 2 years because it is a way for businesses who were affected by COVID to recuperate money, up to $7,000 per employee per quarter now over the last 8 quarters. So, again, I'm showing you a lot of the things that we do because we're a pretty diverse company when it comes to the solutions we have, but you do not want to sell them all. You want to concentrate in an area, even though you'll be exposed to these things. And if you're working in a region and you want to take over that region and bring in agents or salespeople to handle, some of the solutions, you can do that. Okay. So again, I went a little far. I don't, of course, don't go through that with the clients, but what I'm doing here is I am letting them know that we're a real company, that we have an extensive knowledge in what we are talking about. And hey, we've written books about it. Okay. So I also talk about myself here and why, how I got involved in this. So I went through a divorce in 2006. Okay. And I wanted to keep the house. And so we had the house appraised. I paid my ex-wife half of the equity. I bought another house in 2007. Okay. And of course, we all know what happened in 2008. The housing market crashed. By 2010, I was underwater in the first house. Okay. Lost equity in the second house. Like I said, before I started doing this, I was in marketing. We went to a trade show in Las Vegas. One of my associates was talking about how he paid his mortgage. He was paying his mortgage early. So I asked him about it. He told me about the solution. That was in April of 2010. In May of 2010, I got started. Okay. I'm in California. It's expensive here. The two houses, cars, credit card debt, I owed over $1 million. Okay. One of the houses underwater. I got started in May of 2010. And by August of 2017, I had paid off all of the debt. Okay. So over $1 million. First year, between May and December, I eliminated over $100,000 in interest. So December, Christmas, I brought my mortgage statements and bank statements to Christmas dinner, showed my family, and they all got on the program and paid off their debt. I've helped thousands of people since then. Okay. So primarily before this new solution or the integration of the life insurance, it was just the technology, and it is extraordinary. And I'll be showing it to you. Okay. So again, that's how they get started. Now, the technology is called the Money Max account, and it is not new. It was originally the owners, and you'll meet them because they're there's still a private company. They were in the mortgage industry in the 90s. They were doing very well. They're out of Utah. They didn't like the fact that their clients were using their homes like ATMs, continually refinancing, taking money out of the houses. So actually, one of the owners is a techie, and he's really smart. He created the technology. It's a mathematical algorithm, and between 2004 and 2008, and they crushed it. They acquired over 70,000 clients, so they were killing it. Now, in the beginning, the technology only worked on a mortgage, and you had to have a home equity line of credit. Okay, so that was the stipulation. Still, people know about using velocity banking and using a home, using a line of credit to pay down your home. So 2008 came in, and it threw a wrinkle into their strategy, right? People weren't able to get home equity lines of credit. The banks owned a lot of the properties. So what they decided to do was to step back. They continued to sell the solution, not as fast as they did between those 4 years, but they wanted to improve it. In the beginning, it reduced the payoff time on a mortgage by 20%, and it eliminated about 20% of the interest. Okay, so back in 2008, it actually won an award for what it was doing to mortgages, the Ernst & Young Entrepreneur of the Year Award. Okay, they were nominated by their bank, Wells Fargo. They went through the due diligence. They won the award. They were featured in a bunch of mortgage and banking magazines. It's the same award that eBay and Apple won. And then after that, Wells Fargo, who had nominated them, saw an opportunity. They tried to buy part of the company. They offered $50 million for 30% of the company, but the owners turned them down. They were working on improving the technology, and they wanted to protect it from the banks. Okay. So the solution for the debt elimination or mortgage elimination is a software as a service. Okay. It's a technology. It's driven by a mathematical algorithm, and we are disrupting the mortgage industry. The banks do not like us. Okay. So after the improvements, it is big. The owner spent about $19 million after 2008 on improving the technology. Okay. It is smart. It works kind of like AI, a GPS, because it's guiding them. It is pure mathematics. Okay. It understands, though, these 8 banking principles. So closed-end loans, interest accumulation, mortgage amortization, interest cancellation, opened-end lines of credit, interest float and leverage, offset accounts, and strategic debt payoff. Okay. So I'm going to touch on each one of those really quickly, and then I'll show you how the solution works. Okay. So closed-end loans, mortgages, student loans, car loans, personal loans, furniture loans. Okay. This is the kind of debt that once the contract's in place, money flows only one way, to pay down the debt. You can't borrow from it. It's not flexible. If you send an extra payment, they're keeping it. Actually, I had a lady yesterday, and I have a meeting with her today. So we've been talking all week, and she doesn't owe a lot of money, but she's tried to do something with her mortgage a few times, and the banks keep blocking her. And actually and truthfully, they can't do that. They're taking advantage of her. Okay. But amortization, all of those loans that I just mentioned are all amortized. Now, a car loan for 5 or 6 years, that's not that big of a deal, but a mortgage, 30 years. So amortization, I don't know how it's legal, actually. Okay. Amortization allows the banks to accumulate interest. Okay. So as you see here, this is a mortgage that I have on the screen. And yes, that's a high interest rate. But if you guys remember 20 years ago, right, this is what the going interest rate was. Okay. Yes, people are refinancing, they're buying new homes. And so they have lower interest rates now. But the truth is, the interest rate, the APR on a mortgage, it doesn't really matter, right? Even people I meet people who have 2.5, 2.25 right now, and they still are getting killed by the banks. The banks are playing a game with us. Okay. As you can see on this loan, a 6% loan, that number down at the bottom, these people are paying more money in interest than they are for the principal of their loan. Okay. It is amortization that does that. See, the banks move the interest to the front of the loan. The first 21 years in a mortgage, you are paying mostly interest. Okay. So as you see on this loan, their first payment, 83% of the payment of $1199.10 goes to interest. By the time they get to year 21 on this loan, they would have paid $302,000 for the loan. The banks pocketed $202,000. And now they're just halfway to equity. Okay. So even if you do have a lower interest rate, here you see a 4% amortization schedule. But as you can see, 4% doesn't mean anything. If you stay in the house 15 years, look at how much interest you paid, right? How many people pay off their homes? Okay. When you start paying and you're paying well, the bank starts sending you letters or sending you emails asking you if you want to refinance. Yeah, because they want to keep you in the first 5 years of your loan. They're killing it with interest. Okay. So what the technology does, what a solution does is it cancels interest. It rearranges the amortization schedule. Okay. So month 1, they are making their first mortgage payment. Okay. $1199.10. Okay. They have 30 years to go. But in September, with that first payment, they bundle the next 5 principal payments. Okay. So they send in an extra $1,010 with the $1,199. I don't know if you guys all know this or not, but that eliminates the interest that is associated with the principal payments. Okay, so that $1,010 saves them $4,984. Okay, so most of the clients that I'm dealing with don't have an extra $5,000, but hypothetically, let's say they did, and let's say in September they sent in the $1,199 payment, and then they sent in $5,000 to the premium, to the principal of the loan. They would actually eliminate 23 payments from their mortgage. So they would save a bunch of money. So instead of having 359 payments of a 360-month loan, they would only have 337 payments left. Okay. So attacking the principal this way saves them $23,000 on their mortgage. So $5,000 eliminates $23,000 in interest. So what I was saying about the lady that I was meeting with this week, she has a small mortgage. However, she's been trying to send in principal payments. And even though she's instructing the bank to do it, they keep taking the payments and putting them to interest. I also meet a lot of people who are not very savvy when it comes to refinancing in their mortgage, and they end up somehow in a modification. This lady has 53 years left to pay on her mortgage, and they won't take principal payments. Of course, they're going to have to when she goes to the, to Fair Credit Bureau. But right in 2014, the law passed. All mortgage companies have to take principal. Okay. All right. So opened-end lines of credit. So this is the opposite of a closed-end loan. This is revolving debt. Okay. So it's kind of debt where money can go in, money can go out. You buy something with a line of credit or a credit card, right? You pay it off. You can use that money again over and over, right? This kind of debt is not amortized. It's flexible, and the interest is calculated on a daily balance basis. Okay, so it's more favorable. A credit card is the most famous opened-end line of credit. Okay, and what interest, float, and leverage is what we teach our clients is that they shouldn't use this kind of debt the way probably 99% of people in America do, to buy something because you don't have the cash or you don't have the money. This is using this kind of debt with the intent of using the bank's money, right? If you charge something at the beginning of the month and you pay it off in 30 days, there is no interest. But if you go out and get a cashback credit card, right, and the client pays their expenses throughout the month using that credit card and then pay it off at the end of the month, no interest, and the bank is throwing $100 at them, $150 at them. There's a show on Netflix called Explained, and this year it's all about money. There's a guy there who has 25 credit cards, all cash back, and he's making a living doing this. So it doesn't matter what the interest is, because you're just getting the cash back. The banks, they get their money from the merchant, right? Every time the merchant uses this kind of debt, they pay the credit card companies on the swipe. Okay, so the banks are really smart. They are in the business of money. They move money around so that they can either minimize the interest they're paying or maximize the interest they're charging us. When they get it in the right accounts, they leave it there, okay, for the right period of time. When a person makes a mortgage payment at the beginning of the month, they are paying 30 days in advance. Okay. So the bank sweep your account, take the payment, and they invest it for the entire 30 days. So part of our solution is teaching our clients how to bank like banks. In the beginning, the solution only worked on a mortgage, and you had to have a home equity line of credit. Okay. Over the last 17 years, we've used just about every kind of account as an offset account that you can think of. So checking, savings, and all those, they all work. But the one most important one now is the one that you see at the bottom, which is the no surrender charge index universal life policy. Okay. So now the solution works on any kind of debt, secured or unsecured, right? So credit cards, it'll use auto loans, furniture loans, mortgages, right? Now, this kind of situation that you see here is a situation that people are stressed, right? This is lots of debt, different companies, they may be losing sleep at night, okay? I don't know if you guys have all heard of Dave Ramsey. Probably you have. But Dave Ramsey has a method of paying down your debt, okay? It is called the Debt Snowball. And he tells the clients and a lot of followers, churches, he's pretty popular. He tells them to start on the smallest debt, pay it all the way off, move to the next larger debt, pay it all the way off, and then the next larger one. Thus the snowball. Okay. Now, there's nothing wrong with Dave Ramsey. The problem is that he is talking to thousands of people at the same time, right? So he has to really give them a cookie cutter approach. He's not there to guide them. He can't give them something complicated to do. So what he is saying is, hey, here's a way you can have some effect on your debt without screwing it up and then coming back after me. Okay. So with our solution, we take our clients to becoming pros. Okay. Our solution is a mathematical algorithm. They don't even have to think about it. It does all of the complicated calculations for them. When we enter their numbers into it, it creates a strategic payoff. So it's going to pay all of their debt at the same time, but it is going to work on the ones that are costing them the most, the hardest. Okay. So it is much more strategic. In fact, it is a financial GPS. Okay. It works just like a GPS. It has a destination programmed in. The destination is zero debt, zero interest. But the route is as fast as mathematically possible. Right? Just like a GPS. If they make a wrong turn, they miss a turn, it just recalculates. It says, hey, make a U-turn at this next light, and let's get right back onto your route. Okay. It gives them step-by-step directions. It tells them how much money to move. It tells them when to move it, from what account to what account, and it continually calculates the fastest mathematical path to zero debt. Okay. Now, unlike Dave Ramsey and the personal finance gurus that lots of people, go to, most of the time they are telling them that they need to reduce their budget. They need to spend less money. Don't go out to dinner, stay at home, eat beans and rice. Okay. Our solution doesn't work that way. It works with what they give it. It is going to create the fastest path to zero debt without changing their budget, their lifestyle, or their cash flow. Okay. So we need to tell it how much they owe, what's the term, what's the interest rate, payment amount, income, and expenses. When we enter these numbers into the technology, it takes it 30 seconds to figure it out. It's going to give them the fastest mathematical path to zero debt. Okay. So it's not only looking at their past debt, right? It understands that the future, anything can happen, right? They could get sick. They could have a car accident. Whatever happens, it simply recalculates, creates a path from where they are to zero debt as fast as they can get there. Okay. So this is the flow of how it works. Okay. Again, We used to show the line of credit all the time, right? But you do not have to use a line of credit. It will just use your discretionary income, your checking, and your savings account. Okay. Now, what it is doing is it is monitoring everything that they do, their cash flow, how they pay their bills, when they pay them, all of that. Okay. So, month one, they get paid. They make minimum payments to their debt, just like they're doing now. They, if they can, use a cashback credit card for the expenses, and the technology instructs them to send what they are not using to the middle. Okay. So anyone can make payments to the principal, right? You can throw money at it. You can do it. In fact, if you get your mortgage statements from Rocket Mortgage, they're telling you, hey, you could send money to the principal. The difference is if they are shotgunning it, if they don't have a way of doing and knowing exactly what they're doing, they can either send too much money and 6 months later they realize they needed that money, or they pay too little and they end up paying an extra 10 years in interest. Okay. The solution doesn't allow that. Okay. Month two, again, they get paid, they make minimum payments to their debt, and they use a cashback credit card for their expenses. And the excess, their discretionary income, goes to the middle. What it is doing is it is putting them in position mathematically to send the maximum payment to principal without changing budget, lifestyle, or cash flow. When they get there, it tells them to the penny how much to send. That's why it works so fast. Okay. So now I'm going to show you the system. I'm going to break out into the system itself. 1 second here. Set it, and then I'll share my screen for you guys. I know you're thinking already, this is a very interesting way to sell life insurance, right? It's a little slow. I'll share here. It's coming up. Okay. So let's go here. All right. I'm going to show you a demo. This is a live demo of the technology. Okay. And when I asked them in the beginning of the meeting what they're doing, what they want to accomplish, right? I am gathering the information so I know what to send them, what to show them when I get them here. Okay. And this is powerful. So understand this. I've just shown you how or what it does to pay off debt. However, this solution, this technology is way, way more than a debt tool. Okay. It is what I call an interactive financial advisor that they can use 24 hours a day, 7 days a week. It makes them smarter about their money. It shows them the impact of every financial decision they make. If they make more money, it recalculates. If they make less money, it just recalculates. If they have an unexpected expense, it just recalculates. Okay. So what you see here is a live demo. This is John and Rebecca. Right. This budgeting tool, right? It looks like a budgeting tool, and it is. However, it is QuickBooks on steroids. Okay. They can use it for forecasting. They can use it to see what the impact is going to be on something they want to do. So they can put in a purchase or a transaction in the system in the future or now, and to see how much will that cost me? How much will it really cost me? So we don't have to talk to them about their budget because the system shows them the real cost of what they're doing. They can then make the decision on if they want to do that, if it's worth it. Okay, so you see here, this is John and Rebecca. Let me show you who they are. Okay, let me go to their budget. Okay, normal people, they have $402 left over at the end of the month after all of their bills are paid. They're not rich. Okay, however, let me go back to the action plan here. So again, this action plan, and the reason we call it that is because if they follow the directions, simply follow the instructions that the system is giving them, this up here is guaranteed. So they have a 30-year mortgage. They just got the house. They have signature loan. They have credit card debt. They have a new auto loan. They only have $402 left over at the end of the month. I enter their numbers into the system and it calculates. They are going to pay off their mortgage and all of their debt in 11.9 years. They're going to be debt-free 9/15/2033. And they're going to save $143,000 in interest with $402, right? So people only have a couple $100. It still will cut their mortgage in half. Okay, it is an extraordinary tool. Okay, so let me show you kind of how it works. So it does not have access to their money. They still pay their bills the same way they were paying them before. The only difference is these red and blue arrows are the instructions. It's telling them to move money from checking to savings, savings to MasterCard, checking to savings. So if they just follow these instructions, right? This is the math and this is the answer. So everything that happens here now reflects up here. Okay, so they're on their way to paying off their mortgage in 11.9 years, saving 18 years of paying their mortgage. Okay, so the green is income. So John gets paid twice a month, Rebecca once. The blue are their accounts. So mortgage, loans, bank accounts, credit accounts, auto loans are in blue. The black are their expenses. Okay, they can itemize them or they can add them all up at the end of the month and bundle. This is how much we paid on expenses. Again, these are the instructions. Okay, so let's say that John is on commission and he was sick in this pay period. Okay, he only made $200. Okay, I save this to the plan. Again, everything that happens here now reflects up here. So here's the $200. And as you can see here, it added a month to their payoff. Took $1,100 off of their savings. Okay. And it's saying that they need to move money back from the savings to the checking because of his shortened pay. They need the money back in checking to pay their bills. The instructions that were here, they're gone. System recalculated, says we don't have that money right now. Right. So in other words, if they had made more money, it might have added to what they were doing. Okay. So again, they get 3 months at a view. All right. So let's say they have another mishap. Rebecca drives a truck. She's got girls. They play soccer. She brings them to the soccer matches and practice. They're late one night going to a match. There's traffic in the road, an accident. She tries to drive off road around the traffic. She runs over some trash. There's nails in there. All 4 tires flat. She gets towed to the tire shop. Sorry. She gets towed to the tire shop. Oops, I'm doing that wrong. 1 second. Let me go back to the action plan. Okay, so add an action. Here we go. So she's in the tire shop right now. And they're telling her the tires are going to be $1,400. Okay. She categorizes it, vehicle maintenance parts. Okay. She is thinking about using the MasterCard. She's buying tires. We're going to say it happened in this first month, November. So November 8th, she had this mishap, an unexpected expense. Okay, so here it is, $1,400. But look at what happened up here. It added 6 months to their payoff. They're not done now until 5/2/2034. It took $11,000 off of their savings. Why? Well, if you push this button here, it tells you the truth about what you're doing. And what it's saying is if she puts that $1,400 on the MasterCard and they make the minimum payments, by the time they pay that off, it's $5,726.55. Now, in this case, she has to do it, but she doesn't have to use the credit card, right? So she sees that and she says, you know what, I'm just going to write a check. So she changes it, save that to the plan. System says, oh, that's better. It added 2 months. It gave them $10,000 or $11,000 back in their interest saved. Okay. And here it is down here. So not only is it calculating the interest on the credit card, but it's also calculating the change from the original plan. The debt it was going to pay, the interest it was going to pay. And it says that $1,400 in the scheme of your plan is now going to cost you $2,018.55. And it's now telling them that they need to move money from the savings back into the checking, because again, he got paid less. She had an unexpected expense. So now the system is calculating and telling them what they need to do. Okay, so they've had some bad luck here. Let's give them some good luck. Let's say that Rebecca, her boss, has said, hey, you're a great employee. We're going to give you a raise. You're going to go from $24.17 a month to $26.17 a month. So $200. Save that to the plan. Again, what happens here reflects up here. Look at that. It added, or it took away a year and a half. $200, right? System, they're going to be done 10.7 years, now in 2033. And it also gave them an extra $11,000 on their savings in the interest. So if you understand what it did, it simply said, oh, I have $200 more that you're not using for anything. Well, I'm going to pay your debt even faster. Okay. So now when I paid off my houses in 2017, I sold the first house and I kept the second, but then I bought another house in 2018 and another house in 2019. I was going to buy another one in 2020, but COVID came in. Now, a lot of times the way I pose this, because I already know what the answer is going to be with the client, is I say, okay, you're 49, 50 years old, you want to retire at 65, and you'd like to add $4,000 to your retirement. So again, you can, pose it however you want. But what I'm getting ready to do, and I'm going to do this down and dirty without any down payments, but we're going to buy some rental properties. Okay. We're going to buy a mortgage. We're going to call it rental one because we're renting it out. We're getting it from Chase. We're going to pay $250,000. Yes, if we're in California, that is a joke, but of course, across the rest of the country, it could be, right? They're going to pay 5% interest and 30 years. The system tells them what the amortized payment would be. So we add the payment. We're going to adjust the statement. They planned on buying it last month. So here we go. And now we save that. Now, remember, these guys are not rich. So the system tells them the truth. It says, hey, guys, if you buy that property, $400 or $500 a month is all you have, and you don't do anything in 17 months, you're going to be out of money. NSF, no funds left, NFS, right? So we're going to see what it looks like, though, if we put the renter in there. So we're going to add the renter. Sorry, I do that right? Yeah. So we're going to add renter one. We're going to categorize it as business rent lease. and we're going to charge the renter $1,800. And we're going to give ourselves 3 months because it might take us some time to get the renter in there. So by 4/6/2022, we'll have the renter in there. So as you can see here, they're going to have their home they're paid in, they're living in, all their debt, and the second home. Everything is done now in 13.6 years. They're done 25, 15, 20, 35, and they're now saving $268,000 in interest. Not a bad situation for somebody who doesn't have, of course, we didn't do the down payment and all this stuff, but we could do that in the system. We could plan it all, actually. Okay, so we're going to do it again. We're going to plan the future. We're going to buy another home, but we're planning it. We're going to buy it in 2 years. So we're going to call it rental 2, and we're going to get it from B of A. We're going to pay $350,000. It's a duplex, 5% interest, 30 years. System says your payment is going to be $1,878.88. Okay, we're in planning the future. We're not going to buy it until 2024. Okay, so January 8th, 2024, and we are going to adjust the statement to the month before. Okay, save it. So they're better off this time. They'll be out of money in 4.7 years if they don't do something, rent it out or whatever. Okay, and the system tells them, it will tell them the truth if it's 10 years or 20 years, whatever, until they add what's going to make the change. So we're going to add the renters. Right, and I'm going to call them rental 2. We're going to categorize it as home rent. We're going to charge each one $1,200. So $2,400 for the renters, and we are not buying the property until 2024. So January 9th, 2024. Okay. So here we go. But you know what? We're going to give ourselves 3 months to get the renters in there. Okay. So we save it. So look at that, guys. Now they're buying another house. So it's their third house. It added less than 3 years to their payoff, and they're not even buying it for 2 years. They're done 16.1 years, 12, 15, 30, 20, 37, and now they're saving $420,000 in interest. Okay, so in 16.1 years, they have the equity in all 3 homes, and they have $4,200 a month in rental income. Not bad, right? If anybody here thinks they can do that on their own, please raise your hand. I'm just kidding. Okay, so now let's go back here and let me show you how the rest of the solution works. Okay. So my question to you guys, and you probably already know this, but what do the banks want from us? Our money, right? That's what they want. And we give it to them. Checking and saving. They take the money we put in the bank and they loan it to other people. They give us very little, right? Less than 1%. Okay. Banks make money on the spread. Okay. So that means if they're borrowing money at the prime interest rate, they're marking it up and they are charging us another interest, and they make money on the spread. Okay. Banks keep cash or have cash accumulation in 3 ways. Okay. Their money is always working for them. They never let it sit still. right? They're in the business of money. Their money needs to be making money for them. So one of the biggest ways they make money is off of mortgages, right? It's their safest loan because if you don't pay, you can't run away with the house, right? They're going to take it. They're going to keep the money you paid and they're going to sell it to someone else. Okay. Second way the banks make money is recourse loans. Student loans, credit cards can be secured, unsecured, but they charge us for the risk because this is riskier, depending on your credit, right? Anywhere from 5% to 29%. Now, I'm going to ask you guys, if any of you know the answer, please unmute and tell me. Do you know what is the third way? And not you guys are already working here. The third way that banks accumulate wealth or keep it in cash reserve.
Insurance policies.
Oh, come on. You work here. Thanks. Yes, insurance. Right? Insurance, guys. It's called BOLI, bank-owned life insurance. Okay. 20 to 25% of their cash reserves are in life insurance. I looked it up the other day. Bank of America has $24 billion life insurance. They love life insurance, right? And how it works, if you just work for a bank and you're an employee, right? And this is public knowledge. You can all look it up. If you work for a bank and you are an employee, they take out a term policy on you, but if you leave, you lose it. Let's see, somebody did ask. Oh, spread. Okay. Yep. Well, that's good. All right. So if you have your employee, you come in, you leave, they cancel your policy. However, if you are a key person, if you're in management, if you're an executive, they take out a whole life policy on you. They own it. If you leave, you get fired, you quit, you retire. They do not cancel the policy. So 20 years, 30 years, 40, 50 years later, they get that money. Of course, they got money, so they can wait. They got time to wait. Okay. Again, that's BOLI. The corporations do it too. It's called COLI, corporate owned life insurance. Okay. And the biggest holder of life insurance in the country, Walmart. Okay. So it doesn't stop there. Okay. They go to the wealthy, the elite, the well off, and they say, can we invest in your life insurance policy? Think they love life insurance? Yes, they do. And the wealthy says, he's got a $10 million policy, but the bank is saying, hey, we're going to take out a $50 million policy on you and we'll give you 20 million and we'll keep 30 or however they split it, right? It is called premium financing. Okay. So as you can see here, what I'm doing, because you guys are thinking about becoming agents, is I am telling public that the people who know money the best love life insurance. Okay. So our solution that I just showed you, the debt tool. Okay. I'm going to take out my pen here. It will work if you're using a savings account. So if I run your numbers and let's say it says you're going to be paid off in 8 years, okay, and you use your savings account, it will pay off your debt in 8 years. But at the end of that, we all know what a savings account, zero left. Okay. If you use a line of credit, which is where we started, same thing. It will pay off your debt in 8 years. That's what the calculation was. But at the end of it, you will have zero debt, or zero money, right? It'll pay off the loan though. Okay. If you put it in this policy that I'm about to tell you about, and you put the money into the policy in 8 years and you pay off your mortgage, you're debt free, you put in 563,000 and You take out 563,000, then nothing, no big deal. But if you put in 563,000 and you take out $1,000,000, then then you have a problem, and there's a tax problem because you now owe money on the extra money you took out of the policy. Okay. Now, this policy is not a normal life insurance policy. Okay. What happened and allows us to do this is in 2020, because of COVID, there was a lack of money in the bond market. Okay. Insurance companies put money in bonds. Okay. So in order to correct it, Congress passed a law. And these are the laws right here. Okay. 7702-101A. In this law, they are allowing people to put 3 times as much in an insurance policy as ever before. So what I'm showing you next is a confluence of events and things that happened. Okay. But I'm going to compare first the terms and conditions. We all know what a savings account is, but let's compare it to a line of credit. Okay. So line of credit is, of course, governed by the banking laws. Insurance policy by the Internal Revenue Service. And one more thing I just want to say. So this is an index universal life policy. It's not a normal policy. It is uncapped. So if any of you guys have index universal life policies, you know that it can be capped at 9% or 12%, which means that you can get up to that amount from the S&P. It is indexing the S&P 500, not invested in, which means it's giving you the ups only. This one is uncapped. Also, they have a floor at 0%. You cannot lose money. There is no risk. So this policy gives you the death benefit. It gives you living benefits. So if you have a stroke, heart attack, cancer, you can take 90% of the face value and use it while you're alive. Okay. So there are inherent advantages with this policy. So again, the insurance contract is the collateral. A line of credit is a recourse loan. If you don't pay, they're going to collect. They're going to try to get that money. Here, it's non-recourse. How do you qualify? Credit, income, collateral. Over here, your health. Is it reported to the credit bureau? Yes. If you pay well, you have good credit. If you don't, you have bad credit. Over here, not reported. You have a monthly payment due. Here, yes, there's always a monthly payment due on a line of credit or a credit card. Over here, no minimum payment. Can it be canceled? Yes. So over here, I said no, but I just explained to you why. If you put in 563,000 and you take out 563,000, no big deal. The collateral pays the loan, right? If you take out $1 million and you close or cancel the policy, everything you take out above the 563 is now taxable. So that's why we say no. Okay. Again, if you lose your money, if you lose your job temporarily, then you can't make a payment. They are going to chase you and call you. Over here, it's non-recourse. There is no minimum payment due. If you lose your job permanently and you can't make the payments, they are going to chase you until they can't get the money. They're going to write it off, and then they file a 1099 and it becomes income, and the government is going to then want their money. Okay, so as we can see here, the terms and conditions of these two, the life insurance is by far the best. So now I'm going to show you where I'm going with this. Okay, so let's reshare. So I can make this a little larger for you guys in case you can't see it, or for you are on a phone. Okay, what you see here is called an arbitrage. Thus, that's why the name arbitrage. Okay, and what it is a banking spreadsheet. This is how the banks calculate the spread on interest. So, in other words, they pay interest, they charge us another amount, and they make the spread. Okay, so let me set this up for you. Okay, this is a couple who had bought a house for $350,000 with interest. And I'm going to go low. Let's say they were going to pay $150,000 in interest. So they were going to pay $500,000 over 30 years. They used our debt GPS technology, and it eliminated $100,000 in interest and had them paid off in 7 years. They were 40 years old when they got started. So they paid off their house now, and they're 47 years old. What they did, again, is they didn't use a savings account. They didn't use a line of credit. They used the policy that I just described to you guys. They put $400,000 in the policy. And there was one thing that I did leave out about the policy. That is, it is liquid. It is just like a savings account, has the same characteristics. So in other words, they can put 400,000 in, and the insurance company is allowing them to borrow 95% of the money. They can borrow the money. So let me grab my pen here again. Sorry. At 4%. However, the policy is indexing the S&P 500. And we have a couple of different, policies, let's just say, but let's go with Credit Suisse. Credit Suisse, let me do that again, has yielded for the last 18 years, 7.26%. Okay, over the last 18 years, an actual return, not average return. So they are now debt free. They put $400,000 into the policy, and they borrowed $400,000, and they paid their mortgage off in 7 years. So here they are in a great position. They use the technology. Okay. At 47, they can close the policy. The $400,000 gets paid by the collateral. So 400 liability, 400 in collateral. They're debt-free in a great situation. Okay. So they borrowed the 400,000 at 4%, but the insurance company is allowing them to become their own bank. They can continue to borrow the spread at 95% of it. It is continuing to be liquid. So here they are. They cancel it, no big deal. But if they keep the policy open, so they're done at 47. Let's look 5 years or 3 years in the future. Okay, so they're paying 4% on the money, and their cash value is indexing the S&P. We have another one that's been over the last 3 years at 8.5%. Okay, so what you're looking at is, some of you guys may have heard of infinite banking. This is turning infinite banking on its head, right? Infinite banking, they fund the account or the life insurance policy by making premium payments. We're taking their debt. Okay. They, in infinite banking, use a whole life policy, and there's a couple problems with that now. It used to be a 4% guarantee. Well, they changed it. It's now 2%. So a 2% guarantee. Okay. This is indexing the S&P. It is outperforming 401ks and IRAs, right? And the big thing about it is everything you take out of this policy, it is tax-free. So now, 3 years later, they owe $466,000. It's growing by 4%. However, their collateral has grown to $521,000. Okay. So they are now liquid $54,000, and they are their own bank in a non-recourse position. So as a bank, they're going to take the money out and put it on the street. They get to borrow that amount, 95% of it. And now they are spending the money they used to pay off their debt again. Okay, so here we are. They've now taken out 51,000. They borrowed 51,000, and they now owe $518,000. So 518 to 83. Whoops, 83. Okay, and they are 50 years old. They are never going to pay the loan back. They're never going to take the money out of the policy. They're going to continue to borrow. All of the money they take out is tax-free. So at 50, if they pass away, the loan gets paid. If they had $1 million policy, then the family gets the rest of the 500 or the rest of the million, and they've enjoyed 51,000. However, at 55, they now owe 662,000, but in their collateral side, cash value, they have 779,000. They are now liquid $117,000. They're a bank. They're going to take the money out and they're going to send the kids to college. They're going to buy another home. They're going to put a swimming pool in their house. It doesn't matter how big the debt gets, because the bank is never going to, the insurance company is never going to allow you to take more money than you have. Okay, so now they owe 773,000. 773,717, and they are 55. They do not have to wait 5 years. I just don't want to show every year. The money never leaves. They can borrow it as they please. But at 55, again, the collateral pays the liability. Here, 60 years old, they now owe 988,000. However, they have 1.1 million in their cash value. So they are going to borrow. Now they've spent $329,000 during their 12 years or 13 years after they paid off their mortgage early. Okay, and now they owe 1.1 million. 1,155,041, and they're 60. So at 60, again, the liability gets paid by the collateral. If they passed away at 65, then their family gets to 261,000, and they've already used 329,000 tax-free. But they're having fun. They got plans. They are $261,000 liquid. They are going to borrow it. Now they're more than $500,000 they have to spend during their retirement, later years, after putting the kids to college. They've got money continually coming in, tax-free. As long as the policy stays alive, they continue to reap the benefits. So At 65, they now owe 1.724,300. So here they are, 65, and the 1.7 liability is paid by the cash value 1.7. If they pass away at 70, okay, they owe 2.2, but in their cash value, they have 2.5. They are now $390,000 liquid. I would pull the money. They're nearly $1 million that they've added to their retirement by paying their mortgage off early and putting the money into the insurance policy and borrowing it. So at 70 years old, they owe 2.5, a big amount, 74116, and they are 70. At 70, the liability gets paid by the cash value. If they passed away at 75, family would get 582,000 on top of the million, almost $1 million they pulled out already. But they're happy. They got things to do. They're going to borrow it. They've now added $1.5 million to income and retirement. 75, they owe 3.8, 3842,762. And they are now 75 years old. 75, the liability gets paid by the collateral. At 80, they owe $4.9 million, big number, but they have 5.7 million in their cash value. So they're going to borrow it. Do you think they ever imagined before doing this that they would actually add $2.3 million to their retirement? The numbers continue to grow. Of course, we're not going to go with 111, but you can kind of see where I'm going. So this is what hybrid mortgage arbitrage is, guys. We are helping people retire with dignity. And as agents, in a case like this, you would make between $8,000, $13,000 per client. Questions, please.
One quick question has to do with the interest scheme of the banks, right?
Mm-hmm. Yes.
You're paying everything up front, and then you start accumulating equity probably year 13.
You actually no, sorry. I actually didn't show you how good it actually could be, because as soon as they start putting money in, they're earning interest. So it would probably help them pay off their house faster, right? I didn't put that in there. It's just kind of, but it's true, right?
One of the schemes that one of the sales, one of the some of the financial experts say the benefits are, and they changed that law too, is that you have the interest deduction on that mortgage. So they say that, yeah, well, you can write that interest off, during those periods, as long as the house value is below X million.
Oh, you're talking about the money you get back in taxes for having the house?
For writing off the interest.
For writing off the interest. So here's my question. So would you rather get 20, 35% of your money back, or keep the whole 100%? Right? I mean, yes. Come on. Right?
I mean, yes. Thank you. Thank you.
I mean, you're getting your own money back. That's what you're getting on those deductions.
But the people seem to think that the reason why I'm buying this house, and I don't care what the interest is I'm writing that off against.
Yeah, taxes. Well, that's kind of not good thinking, really, because you're just getting your money. You're just getting your own money back. You paid on it. Now they're giving you some of it back.
Got it.
Questions? Anyone else?
Yeah, Ron, I have one.
Sure.
What is the sweet spot as far as age of individuals?
Well, I would say, we've helped people even in their 60s. Okay. So yeah, the earlier you start, the better.
Right.
Definitely, right? Because it's a time value, right? A time, right? We're using the rule of 72, right? Is as you know. So if you're in your 50s, most of the clients I think that we're talking to are usually in their 40s and 50s, and some of them are in their 60s. But this works for all of them. It really depends on, of course, your health, right? What you see over here, we also have a no fee pure index annuity. So if they didn't borrow the money out, they could have just had it go into the annuity, and then they would have gotten paid, so much money per year. But the problem, with that is if you had passed away here, then you would have missed out on a lot of the money that you would have, borrowed out. Right. And that's kind of the way it works. So actually and truthfully, the bigger your debt, the bigger your bank, because we are turning the debt into income and wealth. Any more questions, comments? Yep.
So it really could be beneficial for someone that is not, well, let's say that someone, what would this work for somebody that's 70 years old and say $400,000 in debt, counting a mortgage?
So yes, but getting a 70-year-old qualified for the insurance policy might be difficult. I think after 70, most of the insurance. Hey, Mike, are you on? Mike Amos or Alana?
Mike just took a call like a minute ago. I
Okay.
think he had a 2:00 that was starting. The question about a 70-year-old, I mean,
Yes.
on the debt to wealth side, I've got clients that are 72 years old and they'll be out of debt in 3 years, and versus being out of debt in 30 years and being over 100 years old. So at the same time, they could always insure, like they're one of their kids or something if they had to.
Yeah. I mean, there's ways. So if I'm looking at talking to a couple and one's younger, I'm going to go with the younger one, right? The one who, is healthier versus the one that's younger. So I would say that we'd have to run the numbers. And by the way, so the way we create the policy is based on how much money they are going to have to pay. So if it was in this case, it'll say they had a 400,000 to pay, and they were going to pay off in 8 years. So that means 50,000 a year for the next 8 years. So yeah, that sounds scary. But remember, I just ran the technology. I ran the system. It's already saying that even with your savings account, that you could accomplish that, and it is guaranteed. So it's looking at it, and it's looking at your debt. It's calculating your payoff, and that number is guaranteed. As long as they follow the instructions and the technology, they will be paid off. So the technology is actually instructing them to put the money into the life insurance policy, right? Because it's using to pay off their debt. So we create the policy based on allowing them to put enough money in it each year. After they paid off their mortgage in 7 years or 8 years, right, we can adjust it down. Now, think about another thing about this. Yes, there's premium. We call it a flow premium. And in the flow premium, what we target is $300 a month. Depending on the age, it may be different than that. But remember, in this kind of a policy, 2/3 of the premium goes to cash value. When you're working with a regular, whole life policy, the cash value is built from the premium. So 2/3 of the premium becomes your cash value. But if you think about the other third, think about that. As soon as you put that money in the policy, it's earning interest. And yes, it can be lower than this. It can be higher than this. It can be, right? Each year is going to be different. This is an average of 18 years. So there's going to be ups and downs, but you can't lose money because it bottoms out at zero, right? And so 1 year that you have, because in this time, there was, I think, 3 years of losses, right?
Yes.
Right. And you had 2015, 2018, when we didn't do that well in 2020, right? With COVID. So again, this is what it's yielding. So right now, if you guys understand, this is the kind of retirement that the wealthy use. This is what wealthy people do. They use these kind of loopholes and tax advantage programs. People, normal people, we are under the illusion that a 401k is going to get you there. And I would ask you, in the future, do you think taxes are going to go down, stay the same, or go up?
Can
They're
you
going to go up.
transfer the 401k to this?
You cannot. You can transfer the 401k to an annuity, though. Right.
One
If you,
other question,
sure.
Ron. One of the last things you talked about, or just about the last, you're talking about commissions when this is sold.
Yes.
Now, are these these commissions are paid when?
Okay. So the technology, okay, gets paid when you close the deal. So you get this up front. The commissions on the technology, you start off at about $900 per, and go up to the $1,500. Okay. So that is the money that you get in the beginning. You should be able to close 2 of these a week. And so you can kind of add that up.
Then is there any commissions on the basis of it going forward, each life insurance policy going forward, or is everything just paid one time up
No,
front?
in fact, it is not. That's a great. So everybody gets the same contract with the life insurance. We all get 90%. Okay. And that 90% on the target premium, right, which would be averaging $8,000 as a target premium, you get that money spread over 6 years, right? So because the insurance policy is liquid, we as insurance agents have to take that hit, and we get it spread over that period of time. So we get that 90%, 15% a year. So again, if you close 2 deals a week for a year, so let's say you close 50 deals, you have 100. Now you're going to get paid $120,000 for 6 years as a kind of an average. Okay. We also get paid on the extra money the client puts into the policy above the target premium. So as I just said, they're going to be putting $50,000 in for 8 years. If we're doing 8 years and the target premium is 8,000, you're going to get paid 1.5% on the money that they put into the policy above that target premium.
Okay.
You can recruit agents. You can bring them in. You get overrides on the agents. I'm going to be helping you guys recruit, right? We have a whole plan. Again, as other insurance agents find out about this, because we're selling insurance, as you can see that, we're selling insurance without selling insurance. We're not going in and talking about insurance because people don't want to talk about life insurance until they really need it. Okay. What we're doing is we're using insurance as a tool to help them build income and wealth.
But we will still need to have an insurance license.
Yes, you need an insurance license in order to get paid on the insurance.
Okay, and we need to be licensed in as many states as possible, I would.
So you get insured in your residential
Right.
state, in your residence. And as you close deals, you add the insurance license in that state, right? It only takes, I don't know, what is it, Alana? I've gotten some of them in only a day. So, and they're not that
Right.
expensive, a couple days.
As
you can get
needed.
as needed.
Yeah,
Yeah.
for sure.
Okay, all right, good, thank you.
Any other questions?
Ron, this is Mike Buskey.
Yes.
Really excited. I am not an insurance agent, but I love the concept of helping people, and at the same time, so I have to run to another meeting, but I'd like to pursue this.
Sure.
I need to get my life insurance license.
So,
My son has his in California. I live in Arizona.
okay, great. So just so you know, the technology, you do not need a life insurance license for, right?
Okay.
Okay, you can offer the technology and then you could give the business to your son until you get the license, right? Or right. So you could, right, you're going to see though that, you know, if you're giving, you know, the insurance away, that you want to make that money. So you're going to definitely want to get your license. In fact, Carlene Archie, who answered the question about insurance, she just got her license. So she's ready to get going. Congratulations, Carlene.
And I just want to say that it only took me 2 days. I took a 2-day course, took the exam, and got my license.
Oh, that's great to know.
Congratulations.
I'm going to have to run, Ron.
Thank
Thank
you.
you so much. I'd like to circle back with you. I'd
Absolutely.
like to pursue this very much.
Hey,
Thank
I
you,
have a
sir.
question
Really
for
appreciate
Carl-
your time.
You got it.
I
No
have a
problem. Just
question for
contact me.
Carlene.
Sure.
Carlene, what was the educational platform for the 2-day program?
You could either take it in person or do it online. Where it actually was a Zoom class, but I went to the in-person class. I think the thing that helped me a lot with the class was the flashcards they provided and
Yes.
the actual practice tests that they provided.
Is there a name to that organization?
I do have it. I will send it to Ron and he can send it out to everyone on this meeting. I'll have to go
Understood.
back and look it up and I'll send it to him.
Please do. Thank you so much. Happy New Year.
You're welcome. Same to you.
Arlene, what state are you in?
I'm in Indiana.
Indiana. Is it different? Is the classes and the tests different by state?
Yes, they are. Actually, all insurance is state specific.
Okay.
Yeah. But it mostly consists of pre-licensing and taking the exam. And then once you're in, you're in. You just do some continuing ed every few years. So it's one and done.
Okay, great.
You also only take a test in your resident state. All other states, you just pay the state fee once you have your resident state.
Okay.
Hey guys, 1 second. I'm kind of late for another meeting, but I don't want to leave. I'm just telling her I'll get back to her really quickly. Just a second.
Likewise, Ron, I am very interested in this. Text me and give me a time when we can set up some time to talk. You're muted.
Yes, you got it, guys. Absolutely. Anybody who's interested and would like to pursue it, please. You guys have my contact information. I've been emailing the heck out of you all. So
Hey, count me in, Ron. Mark
got it.
Williams.
You got it. Okay.
Thank you.
Yes. Anyone else? If you have questions, you want to talk offline, I can send you, just email me. I'll send you guys my calendar. And so again, you understand that we have a full suite of solutions, okay, that we are offering to both individuals and families. And of course, this is the core solution. So helping people get out of debt is huge right now. I mean, it is just a big, situation. There's people who have trillions of dollars of debt. And so this is a way that they can take control of their financial futures, getting out of debt, but not only that, then actually, turning their debt into income and wealth.
Again, what are the onboarding documents that to joining the team?
Yes. So to get the technology, it is $150 to be able to offer the technology. And
Okay.
that gives you a national license, and then $50 per year after that. So that's it. You need to have Zoom. You need to have a Google Calendar. Getting contracted by the carriers doesn't cost anything. I get the contracts out to you once you have your license. If you already do, I can get those out to you right away. The other thing is that software that you saw me use to do the arbitrage. That's $225 per year. So it's really
Okay.
inexpensive.
Yep.
And that's it. And then, you guys get started. We will help you with the first couple of sales. We'll kind of do a split on the first couple of sales. You watch somebody who's, really good at it. A CFT is what we call them. Do the sale for you. You split it, you get half of it. And after you do 2 sales, the technology, you can go out on your own. You can recruit, you can bring in agents, you can do anything.
Now, finally, the scheme, the marketing scheme, in terms of, you mentioned initial $22 per lead, but in order to plug in to that system to automate the respondents as you do, what kind of budget does one need to plan for that?
Well, there's nothing. So we create a funnel and we just plug you in. There's no setup. I purposely did it that way so that there was a low cost entry point for you guys to get involved and start getting some appointments in your calendar.
Super.
Okay.
Oh, okay.
That's great.
Yep. All right.
Okay,
And go ahead, please.
I just wanted to state, in a couple of weeks, we're going to be putting on another a webinar on this same topic. So if you have friends or colleagues that you want to introduce, please let us know. We'll invite them.
Is there
Will
a
do.
date set for that yet?
You muted, Ron.
Yeah, it'll be 2 weeks from today.
2 weeks from today.
2 weeks from today. So 2 weeks Friday.
And then the sales meetings are, what's that schedule?
So there are sales meetings. So the guy who created this, who added the insurance part, his name is Dave Weiner. He is, my upline. So, the way the technology is sold is kind of in a network marketing situation. It's not an MLM. You can just sell the technology and make money. You don't have to recruit, but if you recruit it, you can build it out. So Dave Weiner does a training every morning at 8 p.m. Central Time. Okay. And he's going over this. He's talking about it. He's going to the details. He's really a creative guy. He tells you all the benefits. He tells you how to use it. He tells you, perspective of clients. Just for the life insurance, right? Not only the technology itself, but once they understand that. So think about this. If you inherit $100,000 and you wanted to go and put a swimming pool in your house, okay, you have the policy, right? You wouldn't take that $100,000 and go and buy the swimming pool or put a swimming pool. You put it in the policy, borrow from yourself, and then go put the swimming pool in the house, right? Your money then is working for you, even though it's liquid, you're still using it, right? That's the power of this thing. Right?
Win-win.
Win. Absolutely.
Yeah. So when do we get into the sequence of the training calls?
So I will send you guys the link so you can start coming to the calls. I do a training on Saturdays, kind of a marketing and just kind of perspective at Saturday at 1 o'clock Pacific Standard Time. If you can make that. Now, just so you guys know, as you come in, there's another side of the company that is not retail like us, who is more working warm market, right? And they exist and they do well. There's nothing wrong with them. But our side, we kind of got grandfathered in because Dave Weiner, who's doing the training, he created it. And so with us, we're signed directly with the carriers. So if you build a book of business, $5 million in 10 years or 5 years or whatever, you can sell your book of business. You own it. You are direct with the carriers.
Is there another fee to get involved in the business to business part?
No fee, right? I create funnels. I don't know if you guys have seen, I think maybe some of you guys have seen some of the funnels that I've created, but these are also available to you too. Let me show you the funnels, a couple of them. So the financial wellness funnel, or let's go to the debt funnel, and I'll share that with you guys. And so if we have a market, so I'm creating a funnel right now for parents who want to send their kids to college, that we're going to be targeting people who have kids that are in the 6th grade, 7th grade, 8th grade, or whatever, and they will be able to use this solution to build up their money to send kids to college. So this is what this is a funnel right here. So what we do is we send out an email or an ad. They get to download the book for free. When they download the book, they're in the funnel, right? So you guys will each have funnels that you want in order to contact people in your sphere of influence or people that you know or whatever. So we have recruiting funnels. We have the funnels for the debt. We have funnels for the financial wellness, which is the business to business, and so on and so forth.
How would we identify ourselves once we come on board?
What do you mean?
Business wise, in terms of the FCU, you're saying financial literacy. Would we be?
Yeah, you can.
What would my title be?
You be financial educator or financial professional.
Connected to financial literacy group? Or?
Absolutely, right. You can carry the banner. I can set it up where you have an extension here. So it'll ring on your cell phone when someone calls in. You can have your own email. Yeah, because if you are going to pursue the minority, then you have to operate under financial literacy group because
Correct.
Right, because that's who they are recognizing as the certified financial or certified minority company.
Great. I know I had another question. It had to do with that $400,000 mortgage example.
Mm-hmm.
You seem to assume that there's a one dump of 400,000 into the policy. Or
No.
How did?
No. Remember,
on that.
So if they are paying $400,000, the technology has figured out that they can pay that off in 8 years or 7 years or whatever. It is going to be instructing them. Remember when I said that it tells you, it looks at your cash flow, it looks at how you're spending your money, and
Correct.
it tells you exactly how much money to send to the principal. Now, in the first year, just so you know, we try to tell the client not to borrow money. We want them to build up their bank for the first 12 years, even though they could borrow money from the policy, within a month or two. But we want them to build up their bank. So what happens is they put the money into the policy for the first year, and it doesn't really slow them down, because they then on month 13 can go back and do all the things that they would have done throughout that year, right? So again, and then we also offer, just so you understand, we offer a service package, which is kind of gap insurance that covers them if they do have a cancer, or a stroke, or heart attack. So they don't have to touch the policy to get that done. So we cover them that way as well, right? And that's another commission for you guys, right? So it's better that they have like an Aflac policy, and we're using Occidental, that they can pull from, and it doesn't ruin their golden goose that's going to be funding their retirement.
Beautiful. Thank you.
Sure.
And I look forward to seeing you. I've got to run to a meeting.
Yeah, myself too.
Okay. Enjoy.
Hey,
and
thank you
hope to
see
see everybody. Bye.
Please.
Thank you, Ron, very much.
Just contact me, and we'll get you going. Right. I'm going to get you guys plugged in. You guys let me know that you want to get started, and I'll get you the information about the morning meetings, and then you can start getting trained.
Should I go ahead and just go on and acquire those 2 platforms, pay that off? Sign up?
Yes, I'll send you the link for the technology. Anybody who wants to get started with the technology first, I'll send you the link so you can get started with that as well.
Would love to do that. Send that over.
You got it.
Okay, super. Enjoy. Bye.
You want it as well, Cal?
Yes, please.
Yeah, let's send a request.
Yeah. Whatever you can send me, send it, please.
Absolutely.
And please be sure to visit the website.
Yeah. Financial Literacy Group and Betterment Inc. Okay. Were you going to say something, Ken?
Yeah, just go ahead and send it over to me so I can review it, and I'll give you a call because I got a couple of questions on some other items that's come up.
Absolutely.
You got to get to your meeting, so.
Yes. All right. Thank you.
Hey, Ron.
Yes, sir.
This is Ray. We used to
Hey, Ray.
work together. I don't know if you remember me or not.
Yeah, I think I do. I was looking at it because I saw you put a message in the chat. So
Yeah,
yes,
yeah. Can you get together with me or send me some of your calendar link? I'd love to talk to you, please.
absolutely. You got
Thank
it.
you. Have a good day.
All right. Thanks. Thank you, guys. Everybody interested? I'm sorry.
Great meeting, Ron.
You're
Really,
welcome.
really good stuff. And I'm sure a lot of people want your calendar link, to do the onboarding or
Sure. Absolutely.
answer phone calls or, answer questions. So
Sure.
I'm sure you're going to want to send that out to everybody or put it in the chat or both.
Absolutely.
Cool.
Cool.
Well, I've got to
All right.
run to my next thing starting
Me
in
too.
5 minutes, but excited to see everybody here and looking forward to seeing you all again soon. Thanks.
Thank you. Thanks, guys.
Thanks, Tim.
All right. Just contact me when you, at your leisure. You guys all have my email. I'll be reaching out to you as well.
All right. Thanks.
All right. Thank you, guys.
Thank you.
All right.
Thank you, Ron.
Bye-bye.